Good afternoon and welcome to today's webinar, which is an introduction to pensions for Baptist churches. I'm Richard Wilson. I am the Support Services Team Leader here at Baptist House in Didcot, and I'm delighted to be joined by my colleague.
Hello, I'm Steve Kaney, the Pensions Manager now at the Baptist Pension Scheme. I've been here for 6 months, so delighted to be getting more and more involved.
Great to have you with us, Steve. I've been at the Baptist Union for slightly longer, and so I've been here nearly 3 years, and actually spent quite a lot of my time working on pensions issues. And we'll talk you through some of the issues as we go through today's webinar. So that brings me neatly on to an outline of what we're going to talk about today. So we're going to talk a bit about pensions and the challenges involved. We'll talk about your legal obligations and auto-enrolment. We'll give you an overview of the Baptist pension scheme. We'll go into the defined contribution scheme, and I'll explain what defined contribution scheme means later in the presentation. And we'll also talk about the defined benefit scheme, which you'll see noted on the slide here is a closed scheme, but still a significant item on the pensions agenda for many Baptist churches. And then at the end, we will have an opportunity for questions. If you are watching live, you will see a Q&A submission box either to the right or below the video. That gives you an opportunity to submit text questions, and I can see that some are already starting to come through. We will come to those questions at the end of the slideshow. So please do submit them, and then we will try and work through as many of them as we can before we wrap up today. Today's webinar should take around about an hour, but we're not working to a fixed timeline. We'll see how the Q&A in particular goes, but we have got quite a lot to cover, so let's get into the content. Why are we even talking about pensions? Well, I hope, like me, you would have the aspiration that Baptist churches want to be model employers. It's possibly worth saying why I would say we there. So I'm a treasurer of a Baptist church in Caversham in Reading. So I'm both doing this job in the national life of the Baptist family, but also operated at a local church level. So I certainly want my church to be a model employer. And in relation to pensions, I believe that means that we should ensure that ministers and staff in Baptist organisations are provided for in retirement. And we also want to make sure we comply with our legal obligations in respect to pensions. I think those are two minimum standards at the very least. And there are lots of other ways in which we want to be great employers, but I think those in relation to pensions are sort of the key starting point. So just want to touch on your legal obligations. One of the key things here is around what's called auto-enrolment. This was set up by the government a few years ago and basically says that all employers have to provide a pension scheme for most of their employees, or in our case appointed staff. You have to assess staff for eligibility based on age and salary. I'm not going to go into the real detail of this, but you'll be able to find the detail relevant to your organisation through a link that we'll show in a moment. You need to select a qualifying workplace scheme, such as the Baptist pension scheme. A qualifying workplace scheme is one that's been approved for auto-enrolment, and many private pension schemes, which people may already have set up, do not qualify and therefore do not meet these requirements, but you have to select a qualifying workplace scheme. And then you have to enrol the eligible staff. So you've got the eligible staff, you've got the scheme, you have to enrol them, and then you have to re-enrol staff who opt out every 3 years. There are a couple of levels to the thresholds. So above £10,000 income and between a certain age range, you have to enrol staff. At a slightly lower level of salary, you have to offer them the option to enrol, and below that, you can allow them to enrol, but you don't have to enrol them. And in fact, you don't even have to offer the option for salary below a certain threshold. You have to make a minimum contribution level. These have gone up over years, but have now reached the final level. Under the legislation, it was phased in, which means that at least 8% of earnings has to be contributed for those eligible employees, and at least 3% has to be paid by the employer. Now, employers can pay more than the 3%, so you could have 8% where it's 6% by the employer and 2% by the employee. Or you could even give all 8% as the employer, but the minimum total is 8% and the minimum from the employer is 3%. So, and there is discretion for employers to choose within those constraints. And you can find more detail about your obligations on the pension regulator website, which is tpr.gov.uk, and /employers gets you to the employer side of that, and that will take you through a whole sort of self-assessment of what you need to do. And if you are registered as a payroll scheme with HMRC, which if you're paying people you should be for PAYE, then the pension regulator automatically gets in touch with a letter to tell you about your obligations. So, but it is important that you do that and you assess where you are. So I'm going to move on. We don't want to spend all day on auto-enrolment, and I'm going to hand over to Steve to talk us through the Baptist pension scheme.
So this slide is really designed to give a very high-level overview of the scheme. Before looking at the slide, it's probably worth saying Richard has already mentioned about seeking to be a good employer, and this word aspirational. It's worth just commenting very briefly that we're fairly aspirational within the Baptist pension scheme as well, and we'd like to do everything we possibly can, obviously not with the same budgets as some of the commercial schemes out there, but we'd like to do everything we possibly can to be best of breed in terms of every aspect of the scheme: governance, member communications, investment options, etc. So moving on from that, the scheme structure is not simple. First of all, there is a defined contribution section of the scheme, and within that there are three sections. There's the basic section, which, to be absolutely clear, is, as Richard has just touched on, the auto-enrolment part. So the basic section qualifies for auto-enrolment and can be used by any employer within the Baptist family for auto-enrolment purposes. And there's also more information on auto-enrolment on the Baptist pension website, baptistpensions.org.uk. There's then two other sections, which I won't go into the nuances, there'll be more detail in a slide to follow, but there's another two sections which are set up for ministers and staff. There is then the defined benefit section of the scheme. Again, more of that in following slides, but that is closed. So who's who in the scheme? The starting point really is that the scheme is looked after by a trustee, technically one corporate trustee. BPTL is the Baptist Pension Trustee Limited, and that company is registered at Company House, and its directors act as the individual trustees, some of them appointed by Bugby, some of them appointed by members of the scheme in accordance with pensions legislation. It's worth drawing out the point there that BPTL is an independent company from Bugby. It is not Bugby that is running the scheme effectively, although we'll talk about their role in a couple of bullet points' time. So the pension staff, already introduced myself. I'm joined by a colleague, Marshall Rowan, who has really just been here for a month or so. For those of you who may be listening to this webinar, my predecessor Mark retired a few months ago, and Colin Hyam, who's Marshall's predecessor, will retire within the next few weeks. So we're the new folks in town, and Helen Lukey's also works 7 hours a week just to do some support. We use a company called BBS as the scheme administrators. We have an actuarial firm called LCP, Lane Clark Peacock. They act as actuaries and investment advisors. and we have a firm called Eversheds, actually Eversheds Sutherland, as legal advisors. The pensions regulator is a key player in the operation of any pension scheme, so they provide codes of conduct and guidance that the trustees really must follow. And I mentioned about Bugby's role, so they, in some respects, Bugby are one of many employers of the scheme, no more, no less, but in reality, they're the biggest employer and the lead employer in the scheme. There's somewhere north of 1,100 individual employers, mostly churches, but not all of them actually churches participating in the scheme. And there is something, for those of you who don't know, there is something called the Employers Group, which is set up to gather information and to represent the different employers on the pension front. And I and the pension trustees liaise with the Employers Group on a regular basis. We talk about the hub. If you don't know it, you would encourage you to use that. So it's based on BBS's site, but it's for my staff. You can see the address there, formystaff.co.uk. There's a lot of information on that, and just a brief request for feedback that anybody who does use it regularly, please feedback as to what you think of that scheme, good, bad or indifferent. Always interested to hear. So it's provided by BBS, as I've just said, and it allows the employers to do various things. I won't go through each of those bullet points, but allows you to do the key things that you need to do, hopefully, that's why I'm asking for feedback, hopefully on a fairly painless basis. So in the introductory slide, I skipped over the defined contribution and defined benefits section, so it's maybe worth pausing just to say very, very briefly, what is a defined contribution pension scheme? The best way of thinking about that is really just to think of a pot of money into which the individual members, employees, and you as employers invest contributions. Where is it invested in? Well, broadly, we'll say a little bit more about funds in a moment, but broadly it can go into default investment funds or funds that the member selects themselves. The trustee, I've already mentioned, the Baptist Pension Trustee has overview of all of those funds. They monitor them on an ongoing basis, and indeed they take advice. It's quite a tight range of funds. Some schemes out there offer a very, very wide range of funds, but it's a tight range of funds. We think it covers pretty much every eventuality, and as I say, it's monitored. They are monitored regularly. A key point that's worth bringing out, this is a point really more for the members rather than employers, but in a defined contribution in a DC scheme, the member must be aware that the investment risk and reward lies with him or her. So I said earlier that there was different sections, the basic and the members and the staff. That slide, again, I won't go through the detail of the numbers. Happy to cover that in Q&A if anybody so wishes. But you can see just at a glance the different sections. The basic one in there is the lowest contribution rate, and it is auto-enrolment compliant. And the third, like the bottom line on that table, you can see that there is a line for insurances and expense charges. I'll say a little bit more about what those insurances are in a couple of slides' time. But just to make the point at this stage that that's for other benefits on top of pension, on top of retirement benefits. I've already just said that the insurance is actually sorry. So yeah, as I just said before there in the slide, the insurances are sitting outside the retirement benefits, and the two main points up there, income protection, and the second one is life assurance, which you can see is a fairly sizable sum, the greater of two different formulaic approaches, and members benefit from the greater of. The income protection, it's worth pausing just a little bit on that. Not deliberately not put in this slide because it just gets rather complicated, but the pension scheme does provide benefits on ill health, early retirement, and they effectively sit alongside income protection. It's alongside, as in members don't benefit from both. It is an either-or situation, but pretty much everything is covered in there.
It's probably just worth saying from the employer perspective, income protection in particular is a very, very helpful benefit to have. We're aware of churches where a minister goes off on long-term sick, where this scheme can very much make that much easier to handle. Churches wish to, pastorally care for ministers, and that's a great desire. The challenge is if you have a minister, say, who becomes disabled and therefore unable to practically fulfil their ministry, and maybe has 10, 20, 30 years left to their retirement date, it can be very difficult to deal with that situation. And a great burden on the church. This income protection scheme can enable ministers to move on if they are in that situation. So we do highly recommend using this scheme because the income protection benefit is a strong benefit, and we really do advocate using it for exactly that reason. And unfortunately, we've seen some situations where life has become very difficult, where there are ministers outside of who do not have an income protection benefit and become long-term sick.
I have probably said everything I really need to say on this slide and on the previous slide, but just to recap on the investment options for members and under the defined contribution section. So there are lifestyle investment choices, and they're pretty automated, and they start to automatically reduce the risk that the member is exposed to as the member gets closer to nominated or to the selected retirement date. And as I said earlier, these funds are set after really quite a bit of thought and effort on the part of the trustee after taking professional advice. So a lot of thought process. They're not just random funds, because there is an environment out there where there are hundreds of funds and managers available. If the member does not want to go into a default situation, then they can self-select whichever funds they want to go into. Again, it's really just about member knowledge and member wishing to control, take more or less risk as they see fit. I said about trustee selection and monitoring. I'm absolutely delighted to say that at the beginning of this month, the Baptist Pension Scheme was authorised by the regulator as a master trust. That may mean something to some of you. If it doesn't, I won't take up time today to explain what it is. But we have had to jump through a whole number of hoops, regulatory hoops, to gain that status. And it's a great position to be in. The hoops that we've jumped through, am I thinking the wrong? Yeah. Is broadly a higher level of regulation, and we have jumped through a number of hoops which are the same hoops really as the commercial master trusts out there. We are different, as I've said at the bottom of this slide. I seem to be pressing the wrong button here. We don't fit the mould. Yeah, sorry.
I guess, Steve.
Yeah, thanks. We don't fit the mould, the point on the bottom one. So it's been an interesting process, but everybody involved, we're delighted we've got there, and we're starting a new, we're turning a corner really, now that we are Master Trust, different levels of regulation, different levels of monitoring. But that slide links into the previous slide really about giving members and employers comfort that there is a lot of governance and regulation going on within the Baptist family, within the Baptist pension scheme. So the last slide in this section is really just to summarise your obligations as an employer, which we've pretty much addressed anyway, that you really need to pay. Regulation dictates that you need to pay your own contributions and employee contributions promptly within regulatory timescales. You do that via the employer hub on the BBS site. Contributions there are all automatically set up if you follow the processes there. And the last point there, which we've already covered, is to meet the auto enrolment obligations. So that slide summarises your obligations as an employer.
Thank you, Steve. I just wanted to say we've had a message through from some people that the audio quality appeared to be an issue for a period. If that hasn't been resolved, do send us a message through the Q&A and we will take action. But I'm hoping it is being resolved now. We obviously are not watching the webinar at the same time as participating in it, so we do need your help and feedback to try and make things work. So I'm going to go and talk a bit about the defined benefit scheme. So I'm going to talk about what a defined benefit scheme is to start with. We sometimes use the shorthand DB in the same way that DC gets used for defined contribution. So similar to a DC scheme, the employer and employee make contributions. But what's different is the scheme commits to providing specified benefits in retirement. The money received as contributions is invested by the scheme to fund those benefits, but importantly, and highlighted on this slide, the big difference from a DC scheme is the investment risk and reward is with the employers. So if the scheme cannot pay the benefits that were promised, the employers are obliged under pension law to make additional contributions to make up the difference. And I'll talk more about how that works later on. Just to give you an overview of the Baptist Pension Scheme DB section, scheme closed at the end of 2011. It actually, I believe, opened in 1920 something, but there have been no new employees or members, so members of the scheme, so employees within the scheme or employers since then. No accrual of additional years of service, so benefits are defined. I'll talk in a moment about what the benefits were, but benefits usually defined in terms of number of years of service multiplied by the pensionable income. But the one thing that remains in a sense live is that the benefits are still tied to current pensionable income, even though the number of years of service is now fixed. And again, it's a multi-employer scheme with around 1,100 employers, most of which are churches, not all again, but most of which. And there is a very strong overlap between the employers in the DC scheme and the defined benefit scheme, but there are some that are only in one and not the other. The benefits offered, this slide gives overview of. As you can see, there's a certain degree of complexity. There were 3 different phases of different benefits. Pre-1985, effectively, you got a 35th of a standard annuity for every year of service. Between 1985 and 1990, you got effectively 100th of pensionable income for a year of service. So obviously 1200ths by month, so 12 months in a year you get to 100th, and then it moved in 1991 until it was closed in 2011 to an 80th scheme, so an 80th of pensionable income per year of service, or a 960th per month of pensionable service. So that's the exact benefits, and the employers remain legally obliged to fund these benefits. It's fair to say, compared to when the scheme was originally designed, these benefits have turned out to be much more expensive than originally anticipated. There's 2 main reasons for that. One is life expectancy has increased substantially, so those pensions are going to be payable for longer. And secondly, lower interest rates in the current environment than were ever anticipated, meaning that effectively more money is needed now. So if you've got cash now, you need more of it in order to be able to fund a benefit running over a long period of time, because essentially you don't get the same interest returns on your investment, which is a feature of the low interest rate environment that we live in at the moment. So obviously Bank of England base rate at the moment is 0.75%, and if you go back to the mid 80s, you had interest rates of 10% plus at various periods in time, and the change in interest rate means that essentially if I had £100 in the bank and I'm getting 0.75%, then I'm getting 75p a year from that £100. So if I want a flat income stream of 75p a year, I just stick £100 in the bank. If I had £100 in the bank at 10% interest, I get £10 a year. So if you work out how much more money you need to get £10 a year when interest rate is 0.75%, it's an awful lot more money. So that is a large part of why the scheme is much more, the benefits are much more expensive than they were originally planned to be. So where are we at the moment? The scheme currently has around £300 million in assets. I think I checked this morning, and the current readout on the tracking system that we use is 298 million. And that does move daily as investment markets move. The amount of the invested assets of the scheme change in value, and so we get a daily update. They're held in a range of different investments. They're not all stuck in one thing, and that diversity is important because it reduces the overall risk in the scheme, because some of those investments are designed to move up in different conditions. So designed to produce a good return whilst keeping the risk down. So if you put everything in one investment, then obviously your risk is very concentrated in that. Whereas spreading the investments around reduces the level of overall risk. But the third thing we do with the investments is try to match the cost of the benefits. So when interest rates fall and the cost of the benefits goes up, we have a number of investments that are designed to go up with those benefits. So they're called, the main vehicle for doing that is something called an LDI, a liability driven investment. And if you wish to read more about that, I'm sure Google will be your friend, but we won't go into the detail of that today. But the reality is we're trying to make sure that if the cost of the benefits goes up, then so do the investments, so that we don't have a big gap in the funding of the scheme.
I think that's the key point. That there's a bit of a misconception about pension funds generally, not talking BPS specifically. Generally, the role of the pension trustee is not, and this might be a controversial statement, it's not to grow the fund. It is to pay out benefits in X years' time. In other words, it's to produce enough money to pay out the liabilities. So if a fund value, if the asset value goes down, on the face of it, bad news, but it's not necessarily bad news, because you need to look to see what the liabilities are doing.
Yeah.
So it's the link between the assets and the liabilities that's crucial, not the absolute value of either.
Yeah, and we're trying to manage the risk of there ever being any further calls on employer contributions, and I think that's something we can all sign up to. Is we're all trying to make sure that risk is minimised. So under the pension legislation, a defined benefit pension scheme has an obligation every 3 years to carry out a formal valuation. In some sense, quite a simple process. Requires a lot of expertise to do, and it's quite a technical job. So you have to calculate the amount of money you would need now in order to cover the projected cost of the benefits. You compare that cost to the current scheme assets, and where you have a shortfall, and unfortunately at this point in time we do have a shortfall, you have to agree a recovery plan with the employers to address any shortfall. The last valuation was carried out just as of, so it was actually completed only April 2018, but it was calculated as at 31st December 2016, so just under 3 years ago. And at that point, there was a deficit in the scheme of £93 million. And a recovery plan called the Family Solution was agreed in April 2018 to address that £93 million deficit. That involved the Baptist Union of Great Britain contributing an additional £33.5 million. It involved all the employers continuing the deficit recovery contributions that they were previously paying until the end of 2028. And there were some changes made to the inflation adjustment of the benefits, which did make some reductions in the liabilities as part of that. So that was the family solution. There is much more you can read on the family solution webpage on the Baptist site, which is www.baptist.org.uk/family solution, and you can see all the documents that were published then and the latest updates on the progress. But I'm very glad to report that currently the family solution recovery plan is on track. And you can see here a graphic taken from the LCP system that monitors the performance of the scheme, and it monitors the scheme. The graphic there is as of the 12th of September, and you can see that there are two lines on here measuring the deficit. But you can see at the end of 2018, a large lump of money, which was £33 million, went into the scheme from the Baptist Union, and the deficit in there reduced substantially. But you can also see on there that the deficit moves daily with the financial markets. Actually, hasn't moved all that much because of the matching between the assets and the liabilities. In a process that the financial experts would refer to as hedging, which means that the line on here is the difference between the assets and the liabilities. If we were to show you the chart of the assets on their own and the liabilities on their own, they're much more volatile, but actually they move in fairly close relationship to each other, which is why on the right hand side of these charts, since the beginning of this year, you can actually see the progress has been quite flat. And in a sense, that is a good news. Actually, the liabilities have gone up nearly £50 million during this year, but the assets have also gone up by a similar amount. But, and this is a really big but, the risk remains with the employers in the scheme. That's a really important point to note. This is not risk-free. We are on track with the plan that we laid out last year, and we have no reason to believe we're going off track or that anything is wrong with that plan. But much can change, and I won't comment on the current political environment, but as you can see, there is a lot of uncertainty around, and so that risk remains. While this is a live pension scheme, the employers are responsible for those. The pension trustee will come back to the employer if it needs more money. That is the reality. So. Just to talk about, there were two lines on that previous chart. I just want to explain what those two lines are. There are two main ways, and there are actually some others as well, but there are two main ways of measuring a deficit in a pension scheme. One is called technical provisions. This is the cost of the scheme continuing to operate, pay the benefits, assuming, and this is what the amount of money you would need now if you didn't have any future contributions, but that you continue to move along, and there still is some risk. And it is assumed, as long as the assumptions pan out as put in the valuation, then you can carry on and pay all the benefits with no issues. But there is a risk that the actual reality doesn't play out in line with the assumptions. The second basis is something called solvency basis, and this is the basis on which you actually take the assets of the scheme and you use them to buy a large insurance contract with an insurance company, and essentially they then take on the benefit, the cost of paying the benefits and the risk that those benefits are more or less expensive in future, and that essentially removes all the risk. That would be nice to do, but at the moment the deficit on a technical provisions basis is around about £40 to £50 million, and on a solvency basis is around £70 to £80 million. So if anybody has a spare £80 million, if they'd like to let us have it, then we'll look forward to buying a full insurance policy for the whole scheme. But at the moment, we simply don't have the funds in the scheme to do that. So the next valuation is due at the end of this year, so in a few months' time. So the date of the valuation will be as at 31st December 2019. The work on that valuation will actually be carried out in 2020. It may go into 2021 because the deadline for completion is the end of March 2021. But we hope to be able to complete that sooner, ideally by around about this time next year. But we will take the time it needs to do the job properly. Our aim as the union and on behalf of employers will be to maintain the current recovery plan as far as that is possible. There is no reason at this point to say that that's going to be an issue, but even with 3.5 months or 3 months and 10 days to go to the end of the year and the valuation date, it's impossible to say whether that will be the case still by the end of the year. We have every confidence, but risk remains as always. I think it's fair to say the pension trustees' aim, as always, is their legal obligation is to ensure continued security for member benefits. So they are looking to make sure that the members' benefits are as secure as they can be. Essentially, that means they're looking to get the funding as good as possible. And we look to collaborate in the context of our having different roles and different legal obligations. We do aim to have as collaborative a approach as possible, but there are moments when we have to fight our own corners, and that is a good and positive way that each party's responsibilities are fulfilled. Bugby's long-term objective and the employers group long-term objective is to actually to go through a buyout process to get enough money available to pay an insurer to take the scheme off our hands, to take the risk away. And the projections suggest that is a feasible target in a 10-year horizon. Lots of risks in terms of getting there, but we believe it's a feasible plan. In the short term, we are actually doing something that is a step on that road, is that we're actually working with the trustee currently on what's called a buy-in. So rather than buying out, which would mean buying an insurance policy to cover all of the scheme's liabilities, we're looking to cover a portion of them, around about a third of the scheme liability, so of the order of £100 million. We're currently seeking quotes from insurers for that policy, and we are hoping to have, if all goes to plan, we're hoping to have that policy in place by the end of this year. It is a step towards buyouts, but at this point in time we haven't had pricing, so we don't yet know whether we have projections of pricing, but we don't have the actual quoted pricing from insurers. So until such time as we've got that, it's very hard to know whether that will prove to be a good step. But it's something we're working on. And again, if we have a third of the scheme's liabilities insured, then that has the huge advantage that that's a third of the risk that's essentially taken off the table. So I'm just going to hand over to Steve to do a little bit here on some of the other features of the defined benefit section.
Yes, if not a history lesson here, but if you go back to 2005, those of you who remember the Maxwell scandal and everything around about that, and from a pension perspective, one of the things that happened there was that the legislation was introduced to make it much tighter, much harder for employers to walk away from their pensions responsibilities. Why is that relevant for the Baptist pension scheme? Well, in particular, departing employers, those who have got no employees left, must settle their share of the pension scheme liability immediately. That's known as a cessation event, and it's very relevant to the Baptist scheme because of the very nature of ministry. Patterns of ministry means that ministers come and go, and so there have been frequent cessation events. So that aspect, the nature of ministry plus the nature of a multi-employer scheme, means that the Baptist pension scheme has been dealing with a lot of cessation events and therefore a lot of debt issues. So just a little bit more about a cessation event. So employer debt is the phrase that's used there. If a cessation event occurs, the employer must pay their share of the debt. That share is based on an actuarial calculation. It might be worth just quickly cross-referring to one question which I know came in earlier.
Yes, we have had a question that's come in that says why do the figures fluctuate in terms of the employer debt, and what causes that?
Yeah, so the short answer to that question is that it's an actuarial calculation, and all actuarial calculations by their very nature are full of assumptions. Typically interest rates, inflation, projected investment returns and longevity of the member, which is a key point. So for different churches out there, on the face of it, you may think Church A and Church B are broadly the same in pension terms. The minister has roughly been in the scheme for the same amount of time, and the deficits, the debts, turn out to be very different. So probably the key reason for that is around about longevity and the age of the minister. So the short answer is really just it's an actuarial calculation which by its nature is full of assumptions. Those assumptions change. Richard's already talked about interest rates, for example. They change, inflation changes, and as assumptions change, there is the volatility in the debt level.
And essentially the debt level is your share of the scheme liability on a buyout basis. And obviously that liability, although it doesn't oscillate a lot, it does move day to day. And so, the monthly measuring point, there can be a reasonable difference between the overall scheme deficit on a month-to-month basis. Hopefully, you have good months and bad months. So I wouldn't spend your life tracking it on a daily basis or worrying every month. It's just an indication that gives you a guide as to what the situation would be if you were to leave the scheme at that moment.
And if anybody has any specific questions about their own situation, where they are, I agree with Richard. I wouldn't necessarily track that on a monthly basis. But if you're doing so and you have real concerns, please contact us directly, either myself or Marshall. You'll get the details on the website, and we'll look into that for you. So moving on then, but still on cessation events. So I've used the word avoid there. I've used it advisedly. How do you avoid a cessation event? Well, there are things that you can do. Legislation allows you to have a period of grace, which initially is for 12 months, but you can extend it up to 3 years. And there is also an agreed situation between the trustees and the employers group, where you can bring in what we in pension terminology call an interim member, which translates really as an interim minister. So if there's not time just now to go into that in detail, but there are ways in which you can avoid not have to pay your debt. And for historic cases, some of you may be aware that we've been issuing something called the Deferred Debt Agreement, which that's what it says in the tin. You can defer payment of the debt. I want to say a little bit on CIOs and conversion to CIOs, or if you're listening to this in Scotland, you can probably tell by my accent, that's where I am from, SCIOs, Scottish CIOs. An apology here, really, that I know many of you have been waiting very patiently for the pension trustee to say their bit on your conversion process. It's important, it's absolutely crucial that you do not convert to a CIO without the pension trustees say so, or nod of approval, if you like. Why is that important? Because if you don't go through that step, then you hit one of these cessation events, and that can be painful for everybody. So there is a prescribed way of avoiding a cessation event when you're converting to a SCIO or a CIO, sorry. There's information now, or full information, full guidance and draft documentation on the Baptist Pension website. If you've not seen that, I would encourage you to look at that. There is now a patient queue forming of churches who are now seeking to push that forward. And I've been very busy on other things up until now, so I do apologise. Thank you for your patience, but I will be looking at those really as from next week now, and we'll start to deal with each and every one on an individual basis and move that forward.
Thank you, Steve. I suppose just say BBS can advise on the process to follow. So if in doubt, contact BBS as the scheme administrators, and they are well versed on the details of all of these processes. And their details can be found on the Baptist Pension website. And please do ensure that if you have somebody leaving your church, particularly a minister, particularly if it leaves you with no remaining members of the scheme, please ensure that you contact BBS and they can guide you through the process to follow. So I'm just going to talk briefly about, actually there is a choice facing active employers within the scheme. So if you have an active member of the scheme, so if you have a defined benefit membership and you have an active member in the scheme, means you don't have a cessation event, you actually have two choices. So the default option is you continue to participate in the scheme, you pay your deficit contributions, and those contributions may be revised up or down, possibly, or for a shorter or longer period, but than forecast. It may be that we do get to a situation of buyout sooner than the current plan, and therefore contributions stop. But there's no guarantee of that, and it could go worse. It could be 20 years or 30 years. This is not me giving expectation, but just saying the range of possibilities that are possible. And as a continuing employer, you share in the risk of the scheme, so you have that risk. You are a part of that risk process. But you also have a second option, is that you could settle your employer debt. And we do just want to make this clear. We're not making recommendations, but we're just giving you the options in front of you. That means that you would pay a one-off amount and exit the scheme. That means, the employer debt that you see on the portal is an estimate of what that amount would be at the date of that estimate. And of course that varies day to day, but it gives you a good guide. And then you would have no further obligations to the scheme, and you won't share in the future risks. But you can continue to participate in the defined contribution scheme as a DC only employer. So that would mean you no longer pay deficit contributions, but you do have to pay an upfront amount. Now, how do you decide on what would be best for your church? Well, if you look at the contributions you're paying, most churches are paying the same amount of around about £300 per month, but there are variations on that for churches who had multiple ministers. You can compare that to the estimated debt you would have to pay. So the current contribution plan runs to the end of 2028, so you can add up how much you expect to pay in contributions between now and then. You can compare that to the estimated debt you would have to pay in a one-off sum. And then you have to consider things like, well, do you actually have the money to pay that debt if you wanted to? Now, you can come to the Baptist Union Corporation and ask for a loan to pay that debt. We'd be delighted to talk to you about that. But you may decide that's something you do or don't want to do. You may have the cash, or you may not. You may want to sell something to do it. And therefore, and a lot of this comes down to your church's attitude to risk. So I'm not going to go into that in great detail. We're certainly not giving advice, but those are some of the factors you might want to consider. And you may well want to seek independent financial advice to support any decision. We're not qualified or approved to offer financial advice, but you can obtain independent financial advice to analyse your options in that process. But obviously, if you have a very low debt, then paying it seems more attractive. If you have a very high debt, then probably paying it seems less attractive. And the range of debts is quite large and not necessarily very well related to the amount that churches are paying in contributions. So it's just a factor to consider. And I'm just going to hand back to Steve to talk briefly. We're just coming towards the end now. Apologies, we've run quite long. As you see, there's been quite a lot of content. To talk about double cessation events.
Yeah, so these are the last 4 slides now on the final vexed pension issue. I think double cessation events, more jargon, and because of time I'll run through these fairly quickly. But there are about 360 or so, I think it's 365 to be accurate, employers out there who have had at least one cessation event that we spoke about before, and then re-entered the scheme. I don't think I'm pressing the right buttons here anymore. Yeah, we've said there that employer debt regs have a flaw. Probably a better way of putting that is that it really is quite unfair. And the Baptist pension scheme, I've been in direct conversation with DWP over the years about that unfairness. And whilst that's been recognised, it is what it is. Yeah, been a long-standing issue, and on a more positive sense then, so talked about how unfair it is, but on the positive side, the family solution was discussed, it was identified and agreed by all parties, and that created a mechanism to deal with these double cessation events where Bugby will be paying or have paid a contribution into the scheme, which nominally settles the earlier cessation events, leaving churches only with their current liability, which I think all parties agree is a much fairer way of looking at it. So legislation is not really particularly friendly for the Baptist pension church situation, Baptist pension scheme situation and churches out there, but internally the Baptist family have agreed a solution. So more jargon, double cessation debt agreements, DCDAs. If you are in this situation, if this scenario applies to you, you will hopefully have received your letter and your agreement. If you haven't received that, it is in the pipeline. We're working through the 360 odd cases, and these are all in the process of being settled. So the final slide here is really just to summarise your obligations as a DB employer, which is you are obliged to pay off the deficit contributions. You're also obliged, I said double cessation events were the last vexed issue, maybe annual accounts is the last vexed issue. I want to say a little bit about the request to provide church accounts. First of all, to be absolutely clear, it is the pension trustee that needs those accounts. It's not Bugby. The pension trustee needs them because they are obliged, pension trustees are obliged to assess the covenant strength of those many employers who are supporting the scheme. That's a legal obligation. So the trustee has to legally ask churches for those accounts. I have been made aware, some of you may know, we've sent out a chaser recently. Thank you to everybody who's responded to that. There have been a raft of responses in the last couple of weeks, both from ourselves and from the employers group, urging you to do that as well. Thank you for doing that, and apologies because I know that there isn't a tracking system and some of you have been unaware whether you've done this job already, and it's caused a little bit of confusion. So taking that point on board, and we'll hopefully have a better tracking system on the web portal next year. Anyway, to go back to your obligations, you've got a legal obligation to provide annual accounts to the trustees. Read communications, please, that's a plea. But the other part of the plea is that any good communication is a two-way street, and we're very keen to hear from you. As I said earlier, good, bad and indifferent. What is good about the scheme? What is bad about the scheme? Please speak to us. And I think that, the last one, yes, avoid unintended cessation events, which we've really just covered. And that brings us to the very final slide and open it up for some of the questions that we have got some questions come through. It does appear we've had some audio issues with the broadcast today, and I'm sorry about that. That's not been the case with previous webinars. We will try to investigate that once we've finished, and hopefully we will be able to sort that out on the replay. We don't know exactly the cause of that at the moment, but hopefully it was. There are certainly still some people submitting questions. So if you have questions, please do get them in now, and we will start to run through the ones that we have. So the first question I've got here, which I think was submitted before we even started, says, what's the main reason for fluctuation in monthly deficit figures? I think we have covered that one. The next one says, if we use the BPS for our church staff as well as minister, if at some point in the future we have a ministerial interregnum, would having staff in the staff section shield us from a potential cessation event? I think it would. Yes. The short answer is yes.
Yes.
So the problem exists where a church or an employer has no members of the scheme. So if the minister moves on and there are staff members continuing to be in the scheme, there is no cessation event.
We have a question here which says, do you have to use the BPS for auto-enrolment? I think the very simple answer to that is no. You may use any qualifying workplace pension scheme. You do need to be careful to make sure it's a qualifying workplace pension scheme, because there are schemes out there that are not. Many personal pension plans that say somebody might have from of their own and they ask you to contribute to, probably will not fulfil your obligations under auto enrolment. But so once you've looked, you can look around the market. TPR, the pension regulator website, does have a full list, and you can compare which one might be most suitable for your church. We're very keen to make sure for most Baptist churches that the Baptist pension scheme is a good option, but we're not saying it's the only option at all. And you must make your own choices on that, looking at the costs and the operational integration with what your payroll process is.
I would agree with everything Richard has just said, but I'm very biased towards the Baptist pension scheme. I guess I would turn that question round and say, why would you not use the Baptist pension scheme?
Yeah. But we are aware of many employers use the Baptist pension scheme. My church does for all of its employees, but I'm also aware of some churches that have used other schemes such as Nest or some of the others out there. So you do need to make your own choices, and as I said before, we can't give you financial advice. The next question, I think, is related back to the one we were talking earlier on about employer debt. It says, why has our employer debt gradually increased since January? Between July and August, it increased by 5,800. That does sound like quite a big jump between July and August, but I think there were some movements in the financial markets in that particular period, and it may well, by the time the September valuations come out, have gone back the other way a bit. So it's partly market movements. The other thing that does shift your valuation is if one of the people who were your employees in the scheme, if they retire, if they pass away, then your liability can actually change. And because if all the people you were responsible for passed away, then you would no longer have a liability to the scheme because they've been entirely paid. So it is a complicated beast and requires a professional actuary to do those calculations. So it is a complicated one to explain, not easily done on a webinar.
If you have any questions though on your own specific situation that is concerning you, please contact us.
Yes, and if you do uncover that one of the ministers that are in the records as being on your church you don't think is related to your church, then the scheme can investigate that. And sometimes records from 30-40 years ago are not as accurate as we would like. Next question is, how can I obtain a login to For My Staff for each of my church finance team members? That's relatively simple. If you have a login to For My Staff, you can go on to For My Staff and then add users yourself. There's a menu item on the left hand side that says Manage Users, and you can go into there and add additional users. If you don't have a login at all, then you should contact BBS using the details on the Baptist Pension Scheme website, baptistpensions.org.uk. So that is good, and we do encourage all churches to be registered. Both, it gives you plenty of information. It can give you, for example, information on your contribution rates, so that you can, if your say independent examiner or auditor asks you for that detail, you can provide the supporting data quite easily off there, without having to say go and ask for a letter from BBS or whatever. So the next question, it says interim member facility is for employers who are genuinely looking to appoint a new member of the scheme in future. Yes, sorry, this is a point that's come in. I think it's the correct one. So the interim member facility, in terms of avoiding a cessation event, that relates to only if you're actually intending to have a permanent member in the long run.
Yes,
that's correct, isn't it, Steve?
Yes.
So yes, we didn't quite cover that, but there's a level of detail behind periods of grace, interim members, etc. that, in the interest of keeping this webinar under 5 hours, we thought we would summarise. But the important point there is, if you think you're coming up to a cessation event, get in touch and we can guide you through the detail of what needs to be done.
Yes, I think suffice to say that placing an interim member into the scheme is not a guise that should be used simply to avoid a cessation event. It's a scenario that has been agreed by all the parties to avoid the situation where a church who is genuinely looking for a new minister but hasn't yet found one, is to avoid that situation a cessation event and a debt kicking in at that time.
And indeed, my own church, we used an interim member process where we had a three and a bit year gap between ministers, and we had our period of grace for 1 year, extended to 3 years, and then went into an interim member process, and that avoided us having a cessation event, which was very helpful from our perspective. Next question that's coming, it says, if we choose to settle our employer debt, we understand there is a loss of benefit of ill health early retirement benefit. Is this the only benefit the member would lose? Are the remainder of DB benefits unaffected? I must admit, I'm not sure that's true at all, is it, Steve?
Yes, it's a very good question, actually. So 2 parts to it. The second part first, no impact on DB benefits, that's clear. The first part there is, we have focused quite a lot recently on the ill health situation, and as I said in my introduction, I've been here for 6 months. I'm not sure if I can still say I'm the new boy, and I'm not sure, but that's the reality. We aren't sure, and we are currently reviewing, we're looking very carefully at what the rules say and what the practices have been around about ill health. It is really pretty complex. We've not got time to go into it today, but it's a very good point, and if it's a point made in theory, it's a good point. If it's a point made with a real life case behind it, excuse me, then please contact us to discuss that specific situation.
I think get in touch with Steve and he can investigate the detail for you on that. But as a general rule, buying out does not affect the members' benefits primarily. It's mainly about the church's relationship to the scheme.
Yes.
We're now on to the final question that I think we have, which is if church agrees to a double cessation debt agreement. So we did cover these, and there are several hundred of these in circulation for churches to sign. It says, does this affect choice to buy out of current cessation event debt later? And if we buy out, does the monthly debt payment cease as well? So it's definitely true that if you pay your employer debt, that you just stop paying deficit contributions. You have that effectively is your trade-off. You either keep in the recovery plan and keep paying, or you can pay a one-off sum to exit as a one-off decision. That's not a reversible decision. Once you've paid out, you can't come back and say, well, I bought out at the wrong moment and my debt would have fallen. Once you're out, you're out. But in terms of the double cessation debt agreement, if you sign up to that, you can then subsequently choose to pay the remaining employer debt.
Yes.
So it doesn't stop you if you're a continuing employer. You settle your earlier cessation event debt via the double cessation debt agreement at no cost to the church. It's worth emphasising there. Then you then are like a normal employer with no cessation event, and you have the same choices as any other employer. So hopefully that addresses that question. So as we stand now, I believe that is the last question we have. I'm just doing a little check down our Q&A panel here to see if we have any more. No, we've covered that one. No, I do genuinely believe that's the last of our questions. So if you're still there, thank you for bearing with us for just over an hour of this webinar. We will be publishing a recording of this webinar on the Baptist website early next week, so baptist.org.uk/webinars. We will also publish a copy of the slides. There does appear to be potentially been some issues with the audio out there from some of the comments we've had in. As I say, I do apologise for that, and I hope they won't be on the recording. If they are, then it may take us longer to get a usable recording up, but let's hope they're not. We will publish a set of the slides, and then hopefully you can replay and work through the slides yourself at your leisure. If you have any questions, please do get in touch. So support services at baptist.org.uk if you want to get in touch with the Baptist Union, and that can get routed through to me. Or if you want to get in touch with, what's the best email address to contact the pension?
Just use my address in the first instance, skaney, Kaney, @baptist.org.uk.
So yeah, skaney@baptist.org.uk.
If you're stuck, if you phone Baptist House, they will put you in touch with me.
Always delighted to put you in touch if you get stuck, and you're more than welcome to call Baptist House and ask for me, Richard Wilson. Steve works from home primarily, so he's not normally here, but we can certainly get messages to him and get him to give you a call back. Thank you for joining us. I should also say we run webinars on a reasonably regular basis every month or two. We have keep an eye on the baptist.org.uk/webinars page for future webinars. We do try to communicate them via email and other channels when they're coming up. But if you have particular topics you would like to hear us talk about on webinars, then do get in touch via the mechanisms we already mentioned, be it more detail on a particular aspect of pensions or anything else that is affecting your church and you would like to hear more about, then we would be delighted to try and put a webinar together for you. We thank you for your time today and wish you a pleasant Friday afternoon and weekend ahead.
Thank you.
Many thanks.